Hey guys, so today we're going to be talking about Chapter 4 in the Personal Financial Planning course. I will be working off the 5th Canadian edition by Chris Robinson. And in this chapter, we're covering and talking about measuring and controlling personal finances. So this chapter really is more accounting focused than really financial focus, but it just talks about basic accounting concepts such as balance sheets and income statements and the different classifications of our assets. So if you've done accounting before, this should be relatively easy to understand, but if you're new to finance and this is more of a feeler, then it's a really good a few minutes to kind of take and learn about the basic accounting concepts. So let's get started. So how much is the family worth? Well, the family balance sheet or statement of net worth is a photograph of the family's financial standing at a point in time. It summarizes the major assets and liabilities. Assets are the things that accrue value to us, and liabilities are things that we owe, with the balancing figure being the net worth. So the difference between assets and liabilities is our net worth. Our net worth can be negative or it can be positive. Now, assets can be grouped into 3 categories: financial assets, personal use assets, and luxury assets. And these classifications are really important. So financial assets provide income or are part of what you will consume in retirement. These are the most important for planning purposes because they are the resources that determine progress towards financial goals. Okay, and so we'll give some examples in the next slide, but this is really important. So it provides income. So any asset that provides income or that we will use or that we can use during retirement is a financial asset. Now, personal use assets are the ones that you use in everyday life. One of the family's goals is to have the appropriate accumulation of personal assets. So we want to accumulate like some nice assets. So maybe it's a very fancy clothing, a nice car. These are personal use assets that we use every day. Now, luxury assets are also for personal use, but they are very marginal to the family's needs. I think the best example is a cottage. A cottage is a money drainer. It is terrible. It's nice to go up there for 3 weeks of the year, but it costs a lot to maintain throughout the year. And that is a luxury asset. You don't really need it. The home is a personal use asset. It's something else. But for a luxury asset, you don't live in the cottage. So that's a vacation home, something that you go to. It's a luxury asset. And so let's look at a checklist of personal assets. So for financial assets, some examples would be cash. Okay, so cash for us, we can use during retirement. So I would say this is probably one of the most confusing ones because you're like, oh, well, wait, don't I use it in everyday life? Well, yes, you can use it in everyday life, but do you use it in everyday life? Sometimes you don't spend cash. Sometimes you do, but cash is more of a financial asset. It deposits are income generating. Other than that, it's quite easy to understand. Retirement savings, tax refunds, shares, bonds, mutual funds, real estate, all these things provide income. But when it comes to cash, whether it's in a savings account, in a deposits account, a checking account, or you're just holding it, it is a financial asset because you can use it during retirement. You can set it aside, whereas personal use assets you use every day. You can't set them aside, okay? So personal use assets are your personal residence. So another confusing kind of classification is a personal residence, our home, the place that we live in. Well, isn't that a financial asset? Can it not be income generating? Like, what about real estate? Well, real estate is investment real estate. If you have an income property, if you're renting out a condo or something like that, that would fall under financial asset. But a personal residence, although it does provide income and it can provide income, a personal residence is something that you use every day. You live in it, you go in and out of it every day. It's something that you use, and therefore it is considered a personal use asset. And when you think about, well, the goal of accumulating personal use assets, you want to get a fancier home. Same thing with a fancier car, fancier furniture, clothing, appliances, TV, sporting equipment, all these things that we use on a daily basis. And then luxury assets, of course, jewelry, vacation property like a cottage, and valuable collections. You know, if you're a collector, it brings you pleasure to collect those items, but they're not a personal use asset. You don't use them every day. You can look at them every day, but you don't use them every day, and they don't really provide income generating opportunities. Only when you sell them, which a lot of people don't because, again, they're emotionally attached to them. Okay, so what liabilities do we include? Well, we're going to include 2. So current liabilities are due within a month. So they are obligations that are due within the month. So an excellent example would be credit cards, telephone bills, electricity bills, natural gas, heating bills, rent, repair services, income taxes that are due, or a current portion of debt. So those are current liabilities that we need to pay in within a month. Now, a long-term liabilities are due later than 1 month and often are payable monthly for many years. And so some examples are loans. So consumer loans, a mortgage, investment loans, student loans, or amounts owned on leases. So if you lease out a car, the monthly payments that you make are long-term liabilities. Not all of those payments are due within the month. They are due periodically. They're due on a monthly basis. Okay? And so another question that I always get here. Well, aren't credit cards payable monthly for many years? Well, yes, you have to pay your credit card on a monthly basis. Like, you can pay the minimum and then extend it and then accumulate the interest and then pay the next month. But when you're looking at the obligation, you are obligated to pay on a monthly basis. That's what a credit card does. You are able to spread it out and pay across several months, but that's not what we're talking about when we're identifying liabilities. When you're talking about a liability and the timeline of liability, when is it due? We're not talking about the extra interest that you can pay to extend its due date. When is it originally due? If it's originally due, as a credit card is due at the end of the month, then it is a current liability. If it is a lease where you've leased a car for 3 years and every month you have to pay X amount of dollars, then that is a long-term liability. You don't have to pay the additional payments now. You can if you want to, but you pay the minimum, which is the monthly payment. And so that's a long-term liability. So, valuation of assets and our liabilities. These are important definitions as well. So, market value is relatively easy to understand. It is what someone else would pay for the asset in a fair, arm's length, unhurried transaction. And the easiest is if you were to consider the market value of a share in Ford or GM, the market value is the current share price. In the end, that's the market price that people are willing to pay in an unhurried transaction. Now, the historic cost is the original price of a good. The depreciated cost is the historic cost minus an allowance for wear and tear. So the depreciation of that good. So historic cost, say for example, 3 years ago, I bought a TV. And if we're talking about the TV right now, 3 years later, the historic cost is $1,000 still. The depreciated cost would probably be, if, say, for example, the wear and tear costs about $400, so the depreciated cost is $600. It is the historic cost minus the $400 allowance, so $600 is the depreciated cost. And the replacement cost is the price to replace the asset in new condition. Okay? That's relatively easy to understand. Although, you know what? Some people struggle with this as well. So what's the difference between the market value and the replacement cost? Well, the market value usually is something that's new. Whereas the replacement cost can be relevant to that TV that I talked about 3 years earlier. So we can talk, the market value of that TV would be extremely low, but the replacement cost, the cost to buy another item of that same quality would cost a lot more because it might be difficult to find the same TV. Whereas the market value, again, would probably be almost close to zero because probably the TV is not produced anymore and much newer lines are being produced by the company. Okay, so financial assets, you value them at the market always. So you always value them at the market value. And so we talked about, financial assets being, stocks, bonds, mutual funds, real estate. It's always market value. You wouldn't look at depreciated costs. It's market value. Now, personal use assets, you value the house and car, which I said, if you weren't using them on a daily basis, then they'd be financial assets because you could rent them out. But because you are using them, that's why they fall under personal use assets. But they are still potentially income generating assets, and therefore you value them at the same market value as you would financial assets, whereas the value of all other personal use assets are at replacement cost. What it would cost to buy that same shirt, that would be the replacement cost. Now, luxury assets, you value them the same as personal use assets, and liabilities, you value them at the current value you own. So it's not the same as market value, because with liabilities, it's sensitive. A lot of loans are sensitive to interest rates, and if interest rates decrease or increase, the overall amount that you owe changes with that. And so it's important that when you're valuing liabilities, you're not just looking at the market value, but the current value, dependent upon whatever factors will impact the overall amount due. Okay, so human capital. This is, I think, It's easy if you understand it right away, but it might take some time to wrap your head around. Human capital is the earnings power that a person possesses. A doctor has more human capital than a carpenter because she has spent many years to learn difficult skills that societies reward well. So although not reported on the balance sheet, there are 3 important decisions related to human capital. 1, you acquire it. You know, the cost of acquiring those things, the strategy to acquire that human capital in order to ensure future earnings. Then 2, protect it. More life and disability insurance, more to lose. So if you are a higher income generating person in that family, we'll talk about insurance in a later video, but you have to protect yourself. You have to protect your income generating ability by being more healthy, by taking out life insurance. And 3, maintaining it. And maintaining it essentially means that, you know, you want to learn throughout the lifetime. You don't want to just finish school and then give up on learning. Like, if human capital is something that, again, depreciates over time, that you can lose value, your skills might become out of use, especially if you work in the industrial sector. And so it's your job to maintain it, to go back to school, to relearn skills maybe, or learn new skills and attain new certifications. And so not only do you acquire it where you go to school, finish school, but then you have to continue to learn and update your skills because human capital will depreciate. As with any other asset that is reported on the balance sheet, it depreciates over time, and so it's your responsibility to maintain it. Now let's look at quite a full example to see how we would present Don and John's balance sheet, okay? So Don and John need to build a balance sheet. They have $500 in a checking account, $500 in a savings account, and $25,000 in RRSPs, registered retirement saving plans. Okay, Don has some mutual funds whose current market value is $30,000. That's a financial asset, so we consider the market value. They guess their clothing would cost $8,000, and the rest of their household effects $20,000. Their home is worth $430,000, that is the current market value, whereas the clothes and household effects are replacement value, with an outstanding mortgage of $296,000. They can sell both their cars for $17,000. They have outstanding balances on 3 credit cards, so these are their liabilities, Visa of $20,000, MasterCard of $12,000, and a department store card of $4,000. The car loan balance of $5,500 is another loan. So this looks like a lot. And I mean, the question that's in the book takes up an entire page, and I hate writing a lot of words on a PowerPoint slide, so this is a lot for me anyways. But I try to cut it down and really get across the main numbers, okay? And so let's actually take a look at this. So the red would be financial assets. So as I was saying, so their checking account, that's money in our checking account, our deposits, $500 in our savings account, our RSPs, that's investments, and mutual funds, that's another investment. So all of these are financial assets. Therefore, they are valued at market value, all of them. And so these are the market values, 500, 500, 25,000, and 30,000. Now, the green highlighted items are personal use items. So our clothing is personal use. We use it every day. We value it at replacement costs. Our household effects, which essentially means our furniture, everything within our home, the contents of our home, that's valued at $20,000, the replacement costs. The home itself, because we classify it as a replacement cost, because we classify it as a personal use item, it falls under the green category. However, this is the market value. As I said, the market value for house and car, so both of these, for the $430,000 and $17,000, are market value. Now the mortgage. The mortgage is a liability, and so the liability is $296,000, and so that's based on the current amount we owe. Same thing for Visa, the MasterCard of $12,000, and the department store of $4,000, and also the car loan balance of $5,500. So let's take all these numbers, and now that we understand what the valuations are, so where we get those numbers, let's put them into a balance sheet. So for our financial assets, we have that cash, the mutual funds, and the RRSPs. So the $30,000, let me see, I'll just jump between. So we are at the 30 and the 25,000, so the 30 and the 25,000, and the 500 plus 500, $1,000, which is cash. So all this summed up is $56,000 in financial assets. Now, the remaining personal use assets, the clothing, the household effects, the car, and the house all add up to $475,000. And when we add these two together, we get total asset value of $531,000. Okay. Now on the liability side, these would be classified right now as current liabilities, because in the end we are assumed, like the company expects us to pay all of these amounts back except for the mortgage, which is a long-term liability. So the credit cards would all be current liabilities, the car loan would be a long-term liability, and the mortgage would be a long-term liability. And so we've kind of separated and just put it together. So the $36,000 plus $5,500 plus $296,000 for total liabilities of $337,500. So the net worth, we talked about what net worth was at the beginning of the video. Net worth is the difference between total assets at their respective and appropriate values minus total liabilities, which in this case is $531,000 minus $337,500, which the net worth for Don and John is $193,500. Okay, that was a lot of talking. Now the family income statement. So the balance sheet shows the family's financial position today, dependent upon their assets and liabilities to present their net worth. But the income statement shows how it got to today's position from last year. And so it provides the basis for the budget, which we'll talk about later. But essentially, and this is actually, I'll talk about this in a lot of my other finance videos that I have on my channel, but there's a key question in finance, which originates from, would you rather have the balance sheet or the income statement? If you could only pick one, would you have the balance sheet or the income statement? We won't look at the cash flow statement, but pick between those two. Well, any intelligent investor would pick the income statement, because with the income statement, if you have a historical, if you have 5, 6, 7, 8 of those in the past 8 years, you can actually estimate the total asset value of that of the respective company or investment by just looking at the income statement, because those the changes in revenues and the net income are added to cash and retained earnings, which is reflected on the balance sheet. So the income statement feeds into the balance sheet to create those accounts. So the income statement is very, very important. And so if you've never seen an income statement, this is a kind of a rough outline. So we first consider all sources of income, so all our revenues. We then subtract the taxes not paid at source. So if there are any taxes that were not withheld by the employer that we have to pay, we take that away. We then add back any tax refunds that if the government owes us anything, to get net revenue. We then take away our expenses, the living expenses. Then we get our net income. And with that net income, then we can consider non-discretionary and discretionary expenditures, which are very, very important. We'll talk about in the next slide. But essentially, you get your net income. You then subtract non-discretionary expenditures. You get your discretionary cash flow. Then you subtract discretionary expenditures to get our net cash flow. So let's talk about non-discretionary and discretionary expenditures. So expenditures are an outlay of cash, whereas expenses, so let's go back here, expenses are reoccurring. So expenses would be rent. Those are reoccurring expenditures that we know we're going to have to pay, with assuming that it stays the same. So those are expenses that are reoccurring, whereas expenditures are things that are outlays of cash that we are not on a recurring basis, but occur as we make decisions, whether we take out loans or whether we want to make donations, etc., etc. And so looking at those expenditures, we have non-discretionary expenditures, which are ones over which the family has no immediate control over. And this is an excellent example would be usually the repayment of debt principals, or discretionary expenditures, which are ones that the family chooses, and it's usually purchases of major assets or donations. So non-discretionary, you have no control over. Think no control over these expenditures, these outlays of cash. Whereas discretionary, these are decisions that I made. Whether I want to donate to a charity, whether I want to buy a new TV. These are discretionary expenditures that are not reoccurring, because then it would be classified as an expense. But these are decisions that I made. And so you'll actually see that in financial planning, the number one area where you're talking about cutting expenses, about changing the financial strategy of a family, is discretionary expenditures. You have no control over non-discretionary. You still have to make that repayment on the initial debt principal. So when that repayment is necessary, you will pay it. Whereas with discretionary, do I need to donate right now? Do I need to buy this new flat screen TV? No. This is the area where changing majority of the spending habits occurs. Okay? Now, let's look over some guidelines in personal debt management. These are just some these are some common rule of thumbs that a lot of financial planners always suggest. So number one, consumer debt should not exceed 20% of take-home pay. So the amount that we have in debt, the amount that we are in debt, should never exceed 20%. Okay, so if I have if I make $100,000 in take-home pay, the maximum amount I can have in consumer debt is $20,000, okay? Number two, the family should pay down or pay off consumer debt as soon as possible. This is something, I come from an immigrant family. My mom hates debt all the time. She raised me with the belief that if you see debt, pay it off right away. Don't let it stay, right? So that's very important. Three, this is something that's quite important. Three, convert consumer loan into an investment loan. It is better to borrow for investment than for consumption. And so I'll actually give an example later on. So we'll talk about that in the next slide. And then step four, on any new borrowing, check if there is negative cash flow and ensure that the family can service the debt. So if you are going to consider taking out a loan, see how much the monthly interest payments are and see if I can service that debt. If I can't, you should not be taking it out. You should not be paying debt using other debt. You should not be financing your interest payments using your credit cards. You should be comfortable in paying those interest payments. Okay? So now let's talk about the rule of thumb, the rule number 3. So what does it mean to convert a consumer loan? Well, say for example you have $36,000 of credit card debt and $30,000 in mutual fund units. You can sell your, and this is actually the Don and John example, by the way. So you can sell your mutual fund units and use the proceeds to pay down a portion of the credit card balance. Then replace the investment income. You borrow $30,000 and reinvest. So you have now lowered the monthly interest rate you paid. You have converted your customer debt into investment debt. Okay, what does that mean? Let's break it down one more time. So say, for example, you have a loan of $36,000 and you have invested, it doesn't have to be mutual funds, it can be stocks. It's some type of liquidity, some form of asset that is worth $30,000 that earns you some money, okay? So the credit card debt will hurt you because you'll have to pay interest payments, which slows you down, whereas this mutual fund will help you because, again, it will give you returns, whether it's monthly dividends or quarterly dividends, so it will earn a rate of return. What you want to do is you want to sell your investment so that you can pay off that debt, so that you can lower the amount of interest that you have to pay, which is hurting you. And then you'll have a remaining amount of $6,000 in credit and in loans. But then you're not in a good position there because, well, if I was depending upon those $30,000 and the dividends that I was receiving from those $30,000, where am I going to get it from? Well, now you essentially convert it. So now you take out the $30,000 and buy the same units or buy similar investments. And so essentially you've replaced you've lowered your interest payments on the credit cards, whereas the investment income is still there because you still have the same $30,000, but now you are paying for the investment income, whereas you instead of paying for the $36,000 in credit cards. So it's better to pay for investment loans. So talk about here, it's better to borrow for investment, not for consumption. And so when we talk about that, that's essentially what it means. So if you have an asset and a liability, use the asset to reduce the liability and then take out a loan to finance an asset that will generate you income. Okay? That's relatively simple. Other than that, here are some other rule of thumbs, so other personal financial planning guidelines. So number 1, save 10% of your take-home pay. This is something that it's called tithing. I read a book. It's I forget the book's name, but it talks about how millionaires always are tithing. So a tenth of their earnings is put aside to savings and charitable donations and giving back and kind of really providing a community for you to grow your business in. Okay, so save 10% of your take-home pay. Number 2, pay yourself first. So analyze expenditures and cut later. So pay yourself first essentially means that you write yourself a check. So at the beginning, whenever you receive a salary, you can actually pre-plan this with your bank, where your bank will take $200 of that salary, and it will, whether it will invest it in a savings account or it will invest it in another income generating asset. You pay yourself right away. So you analyze expenditures and cuts later, right before anything else that you can do with that money that's put into savings. And so that limits you from actually kind of deviating away from your financial strategy. So step 3, or rule 3, set up an emergency fund equal to 3 to 6 months of take-home pay. Each time you are paid, you write a check to yourself before anyone else is paid. This is if it's ideal to have something like this, but I always think about it like 3 to 6 months. That's going to cost me an engagement ring, so I'm going to blow up my emergency fund to buy an engagement ring. No, well, I mean, essentially, what you should be doing with this rule of thumb is that you need to have X amount of dollars put away for a rainy day fund. Whether it's going to be 3 to 6 months of pay, okay, if you want that, that's a really easy rule of thumb, or it can be 1 or 2 months, as long as you have some money set aside for whatever goals you want. And now talking about goals, rule 4, set short-term goals with deadlines of 3 years and set long-term goals with deadlines of 3 years and more, okay? So let's talk about the family budget. So we talked about the balance sheet, the income statement, now the family budget. The family budget is a projection of revenues and expenses and expenditures for a future period. It is prepared for several reasons. You can control, so it's prepared for controlling spending, providing a benchmark to compare actual spending to what projected spending was in the family budget. It's for checking liquidity. It relates to the ability of a family to pay its current and near future bills without borrowing money. And it relates to planning. The budget focuses attention on the family's goals, since many of them relate to the accumulation of money. So essentially, once you know your balance sheet and you know what your financial position is, and then you look at your income statement and you're like, okay, where's all the money going? I can then finally build a family budget and say, okay, I project that these reoccurring expenses are going to continue, but my discretionary expenditures, which we talked about, I'm going to cut down on that. And I will control spending, which is 1. I'll check my liquidity. So every 3-4 years, I'll look back at my balance sheet and say, how much cash do I have? How many financial assets? So I look at my liquidity. And finally, I make projections. I make financial goals. We talked about this in the last video in chapter 3, talking about a financial goal, which needs a monetary value and a deadline. Okay? Other than that, yeah, that's pretty much it. So as always, there are multiple choice questions that I have provided for you. So the answers to these multiple choice questions are in the video description. I will read out the questions and you can pause the video, we'll try to work on them and then compare them to the actual questions in the video description. Okay, so question 1, in the statement of net worth, which of the following statements is true? So this is something to the balance sheet question. Which of the following are discretionary expenses? Okay. Number 3, which of the following statements concerning human capital is false? So this is what we talked about, human capital and the earnings ability of an individual. So this is one of those questions. And question number 4, which of the following is not normally classified as personal use assets? So this talks about the 3 categories of assets. So the financial assets, personal use assets, and luxury assets. And number 5, which of the following is not a good reason for preparing a family budget? Okay, so this is the final one, and we talked about the 3 goals, which were, controlling spending, checking liquidity, and family goals. So I think I actually gave you the answer, but okay. Okay, other than that, that's pretty much it. So as always, I have provided the link to in the description to provide to send you to Amazon so you can buy the book. So if you're interested in really learning about the course or going more in depth, I do recommend that you check out the book. So Personal Financial Planning 5th edition, the 5th Canadian edition by Chris Robinson. And if you are interested in financial markets, if you are interested in investing and learning more about the stock market, I write for Seeking Alpha. I publish a lot of research reports for them. So please do check out my research. I've provided my profile link in the description as well. Other than that, good luck, guys, and hopefully, if you have any questions or concerns, just comment in the video, and please like and subscribe. Having fun making these videos, and I'd love to make more. Thank you, guys.